Insurance. Life is unpredictable. Eventualities can occur. It is very difficult to predict them beforehand. Eventualities may be in a simple form of being stranded on a highway or running short of cash in a foreign country. It may also mean loss in business terms due to fire in a godown or sinking of cargo in a vessel in mid-seas. It can be much more complicated at times. It can mean encountering a natural calamity like an earthquake or a tornado, which may result in loss in property or life or both. Whatever be the reason, one thing is sure: recovering from the loss takes time. Recouping from the same is never immediate. There is help in such a situation, and that is what insurance is all about. Well, it does not mean we are protected from the eventuality, but it does mean that insurance provides the strength to the user to face this situation boldly to a certain extent. Take for example the case of Mr. A and Mr. B, both of them residing in the same society when 26/7 struck Mumbai city. Well, Mr. A had insured his house for loss due to floods for an amount of 1 lakh rupees, whereas Mr. B had no insurance for his house. No doubt, both of them would have to go through the ordeal of torrential rains to the same extent. But after the event is over, Mr. A would be in a better position than Mr. B. The reason is simple to guess. Whereas it is the insurance firm that will repay the extent of actual loss to Mr. A to a maximum cover of 1 lakh rupees. Mr. B has to bear the entire loss himself. But insurance cover does not come free. There is a price tag to it, which is known as premium. Premium is a small amount an insurance company charges for the coverage it offers. It is non-refundable. Thus, in case of non-occurrence of the event, the premium is not refunded. For example, insurance companies may charge a premium of 600 rupees for insuring a property against theft, floods, fire for a cover of 1 lakh rupees. The premium may vary from company to company. It also depends on the location of the property. How can an insurance company survive in business if it needs to pay an amount of 1 lakh rupees for just 600 rupees premium? Or, in a more generic term, how can such a small premium take care of a much larger sum assured? Just like Mr. A in our case, there are thousands of people who opt for an insurance cover, each one of them paying a premium just to keep the policy alive. These premiums accumulate to form a large fund to cope with such eventualities which may affect only a few policyholders. In case the stakes are very high, the insurance company may insure itself by purchasing insurance from a reinsurer. Insurance can be of two types: life insurance and general insurance. Life insurance covers the life of a person. It is different from all other types of insurance cover. It shall be dealt with in depth later on. General insurance. Insurance other than life insurance falls under the category of general insurance. A few of them are listed for understanding. Marine insurance and fire insurance need a special mention here. Marine insurance. Marine insurance provides protection against loss by marine perils or perils of the sea. Marine perils are collision of a ship with a rock, or a ship attacked by enemies or captured by pirates, to name a few. These perils cause damage, destruction or disappearance of the ship and cargo, and non-payment of freight. It is a device wherein the insurer undertakes to compensate the owner of a ship or cargo for complete or partial loss at sea. The insurer guarantees to make good the losses due to damage to the ship or cargo arising out of the risks incidental to sea voyages. The insurer in this case is known as the underwriter, and a certain sum of money is paid by the insured in consideration for the guarantee or protection he gets. Marine insurance is slightly different from other types. There are three things involved, that is, ship or hull, cargo or goods, and freight. A. Ship or hull insurance. The insurance policy is for indemnifying the insured for the losses caused by damage to the ship. B. Cargo insurance. The cargo, while being transported by ship, is subject to many risks. These may be at port, that is, risk of theft, lost goods, or on voyage, etc. Thus, an insurance policy can be issued to cover against such risks to cargo. C. Freight insurance. If the cargo does not reach the destination due to damage or loss in transit, the shipping company is not paid freight charges. Freight insurance is for reimbursing the loss of freight to the shipping company, that is, the insured. Fire insurance. Fire insurance is a contract whereby the insurer, in consideration of the premium paid, undertakes to make good any loss or damage caused by fire during a specified period up to the amount specified in the policy. The risk covered by a fire insurance contract is the loss resulting from fire or some other cause, and which is the proximate cause of the loss. If overheating without ignition causes damage, it will not be regarded as a fire loss within the meaning of fire insurance, and the loss will not be recoverable from the insurer. The differences between life, fire, and marine insurance are as shown. Basic functions of insurance. The functions of insurance can be broadly bifurcated as 1. Primary functions, 2. Secondary functions, 3. Other functions. Primary functions of insurance. Providing protection. The most important function of insurance is to provide security against future rise, accidents, and uncertainty. This does not mean that the eventuality can never occur. All it means is, in the case of an eventuality, the policyholder is in a better position to face it. This is because it provides cover against economic loss by apportioning the risk with others. Collective risk bearing. Insurance is an instrument to share the financial loss. It is a medium through which few losses are divided among a large number of people. Premium received from all the insured is pooled together, and out of that fund, the persons facing a specific risk are paid. Evaluating risk. Insurance fixes the likely volume of risk by assessing diverse factors that give rise to risk. Risk is the basis of ascertaining the premium rate as well. Provide certainty. Insurance is a device which assists in changing uncertainty to certainty. Basic functions of insurance. Secondary functions of insurance. The secondary function of insurance is to reduce loss by sending surveyors and assessors on a premises to make assessments and recommendations. This is achieved by warning individuals and businessmen to embrace appropriate devices like observing safety instructions, installation of automatic sparkler or alarm systems. Other functions of insurance. Acts as a saving investment scheme. Insurance is in fact a savings option by itself. It saves unwanted expenditure by arranging money flow. It provides benefits from income tax exemptions. In short, it manages the monetary structure of an individual economically. A device of procuring foreign exchange. Being a part of international commerce and business, almost any nation or country can procure foreign exchange. This can be carried on through marine insurance policies and many other ways. Risk-free trade. Various kinds of insurance policies help in making foreign trade risk-free. Principles of insurance. The principles of insurance are the rules of action or conduct adopted by the stakeholders involved in the insurance business. They are as under. A. Insurable interest. Insurable interest means that the person opting for insurance must have pecuniary interest in the property he is going to get insured and will suffer financial loss on the occurrence of the insured event. This is one of the essential requirements of any insurance contract. Therefore, a person can go for insurance of only those properties where he stands to benefit by the safety of the property. In case of any eventuality, the insured will suffer loss, damage or injury. Thus, if you want to insure the Taj Mahal or the Red Fort, you will not be allowed to do so as you do not have any pecuniary interest in these properties. B. Principle of utmost good faith. Uberrima fides. An insurance contract is a contract of Uberrima fides. It must be based on good faith. It is the duty of the insured to voluntarily make full, accurate disclosure of all facts which are material to the risk being proposed. Similarly, it is necessary for the insurer to make clear all the terms and conditions in the insurance contract. If the insurance contract is obtained by way of fraud or misrepresentation, it is void. Thus, in case of life insurance, the proposer must disclose the true age and details of the existing illnesses or diseases. Similarly, in case of insurance of a building against fire, the proposer must disclose the details of goods stored if such goods are of hazardous nature. C. Principle of indemnity. The insurance contract should always be a contract of indemnity only and nothing more. According to this principle, the insurance contract should be such that in case of loss due to the eventualities mentioned in the contract, The insured should be neither better off nor worse off after receiving the insured amount. The main object of this principle is to ensure that the insured is not able to use this contract for speculation or gambling. Insurance is a federal subject in India. This sector has gone through a number of phases and changes. In 1999, the government opened up the insurance sector to private companies. It also allowed foreign direct investment in this sector up to 26%. Since then, it has become a booming market by itself. Well, do we need to argue over the benefits of insurance? Insurance covers large expenses caused by things which are out of our control. But when they occur, they amount to huge expenses which can wash away hard-earned income. Insurance is a wise choice. It means you are being prudent with your money as well as your property. As there are many players in the market, it is necessary to choose a company of good repute. It is also necessary to read the policy document carefully. Compare policies of different companies before finalizing on any. Of course, it does not mean that you are totally safe and eventualities would never occur, but it will surely help you recover easily if they do.